sessions. But let's talk about some new listings. In an otherwise, tepid sort of market over the last two trading sessions, we've had one listing, which is Midwest, that's listed at a 10% premium to its issue price. Importantly, let's see where the company goes from here, what kind of diversification plans that they have beyond the black granite. We have Ramachandra Kollareddy, who's the promoter and CEO at Midwest, joining in. Thanks a lot, Mr. Ramachandra, for joining in. Congratulations on your team and to your team on this momentous occasion, and wish you season's greetings as well. So this Diwali has brought you some good joy and a fair amount of wealth to your investors as well, 7% to start with. But, what the street would really want to know from here on, what is the scalability that you have on your revenues as well as EBITDA margins? If I look at your EBITDA margins between, FY23 and FY24, there was a near 10 percentage points jump. Now it's at that 27% mark. What is the kind of EBITDA margin run rate that you can expect, which is sustainable from here on? And what kind of revenues do you believe you can post?
Sure. Most of the EBITDA has been driven by the innovation conversion from fossil fuel-based energy to green energy. We have a lot of electrification happening, so that's a one-time which is going to continue. And in terms of the largest tailwinds are going to come from our new businesses, which is quads for engineered stone as well as solar glass industry, which we have commenced production last quarter. And that is in the short term. And in the medium term, the growth drivers would be the heavy mineral sands project, out of which we will supply the feedstock to the titanium downstream industries, as well as the byproduct monazite, which will cater to the rare earth industry.
So what kind of margins can you post at peak, and what is the sort of revenue run rate that one can post? It's currently at around 150-200 crores per quarter. Do you see it going 250-300 crores in the very near future?
That's all the efforts are in that direction. But what I would like to highlight is our margins of current business are sustainable because of the cost measures and the positioning of the business that we are in. We are sitting on a resource which is rare and supplies to a global feedstock in terms of the granite. And if you look at the margin profiles of similar companies, though they are not in India, outside India, for example, Iluka, which will be a reference in Australian exchange for heavy mineral sands business, their margins are upwards of, it's listed on ASX, upwards of 40s. And in rare earths, you can always refer to companies like Linus Rare Earths, which is also listed overseas, and you can look at those numbers. So I think a lot of growth drivers, not only from the product point of view, but I think from the supply chain point of view, where we are at a point in history where world is looking forward for these materials, which we have gotten into a few years back right now, and they want the supply source to be outside China. I think that is what will be driving the margins also.
All right. Hi, Mr. Ramachandra, and congratulations to you, your family, as well as the team with regard to the listing. I saw the younger generation as well there ringing the bell, so always feels good. That said, trying to pull out a couple of numbers from you. You said that margins are sustainable around this 27% or thereabouts of what you've reported. What about revenue growth? You've been growing in double digit. Do you think you can do this? And if that is the case, then by FY27, you should be close to around 850 crores of revenue at least?
The growth in the granite business is sustainable. You can see the growth over the last few years. But I think biggest tailwinds are happening on the quad side for us for FY27. And I think we are looking at good growth, I would say. I don't want to throw out a number there, but we are looking at good growth.
What is your revenue potential, sir?
Revenue in terms of potential, we have a quads right now, first phase which have commenced, which is around 250,000 tons at an average of 10,000 rupees per ton is what we're projecting. And we're doubling up that capacity with the proceeds of the fund, of the IPO. So, and in the long term, we are having a large resource of quartz. So with the solar glass business growing at 30% CAGR, I think our challenge will be to take the growth out there more than the consolidation.
So quartz business itself, quartz business can do around 250 crores. You're saying you're doubling that, so that has a potential of around 500 crores. And the current business potential is how much?
That's right. So current business, we are growing at last year's the CAGRs. You can take those numbers, and our aspiration is to be in line with those.
Okay, so 10 to 12% is where your granite business grows. This additional kicker comes in from quartz. You said solar business as well. So at peak, say 4 or 5 years from now, you can very well be a 1200 to 1250 crore company. Would that be off, or was it fair in that direction?
More or less.
More or less. All right, take that point. And Black Galaxy currently accounts for what? Black Galaxy Granite. That accounts for about 70% of your current revenue. With all these diversifications that you are doing, where will that be in your overall revenue mix? And at the same time, what will your overall margin look like then? Because some of the international peers that you're talking about in quartz, etc., are doing 40% plus. So at over 1200 crore revenue, what will your mix look like? And at that time, will your margins be closer to 35, 36%?
That's the aspiration we have, because the peers are almost at those levels. And India, fortunately, we have a lower cost base, which helps us. And we are blessed with natural resources closer to our manufacturing plant. So these are all bulk products which have high logistic costs. So we also have advantage there. So given that, yes, if you're looking at a 3 to 4 year time frame, we will be heavier on the new verticals, which is quartz and HMS. I think that will be their tilting point.
So that will be more than 50% of your contribution? Do you have a target?
Yes.
Okay, all right. And quickly, China, I think you get around 50% of your revenue from there. Any plans on de-risking yourself from China? What would the ideal revenue contribution coming from China look like?
Right. So China is a very peculiar, and the market has supported us for the last 8 to 18 years. And China, what's happening in China is China has become the EPC contractor for the world. So if you look at all the skyscrapers, all the malls, all the tall buildings globally, majority of the EPC companies are the Chinese companies. And their supply chain inherently lies within China. So for example, if you have a $100 million building and you need a $2 million worth of stone, they're not going to import from source of Italy or India or any of these countries. So the raw material goes from all these countries, like from us, and then they do the end fabrication and installation in any given country in the world. So that has been the tailwind, and India is growing very fast for us. Middle East is very strong for us. So if you look at the historic numbers, China has been coming down. But at what point our aspiration as a company is to get the best value for our product, because it's a unique product available only in one village, and we want to make the best of it. And since we follow mostly no credit policy, and China is no credit market, I think as a company we will take as much as we get from there. But we're seeing a lot of tailwinds in India and Middle East. Take
that point entirely. Tailwinds is what you're seeing, but will be very interesting to see, how much of that is already in the price, given the sort of pop that we've seen at the open itself. If I back calculate the numbers that you're talking about, 1,200 crore in terms of revenue by FY30, 35% margins would give you about 400 crores of EBITDA, for 20 crores to be specific. And that makes your company valued at 10 times EV to EBITDA when you look at it from an FY30 perspective as well. Interesting to see how the street reacts to that for a mining company. But thanks a lot once again.
I would just like to add that I would just like to request to look at the peer companies that I've just mentioned, and I think you can figure out the numbers.
Right, we'll do that. Thank you so much for joining in and giving us this clarity. With that.